think in the short term, I would be surprised if Bitcoin was not trading over 200,000, like let's call it the next 6 to 12 months. It might be faster than that because, I mean, we look at how much the ETFs are buying. We got the corporate Bitcoin Treasuries buying another 300,000 coins. We got, what new minted coins, 165,000 per year. So we have a huge supply-demand imbalance. And we think there's a very strong case for, and I'm not giving investment advice, but we think there's a very strong case that Bitcoin can 10x from here. $1 million Bitcoin will not be surprising to us.
Sean Bill joins us today. He is a CIO of Blockstream. We're going to get his outlook on Bitcoin and how his fund is operating now and what his strategy is for Bitcoin. I'm David Lin.
Bonnie Chang.
Sean, so good to see you. We both share a macro background, except I'm not a trader. You were.
Yep.
And you were the first pension fund. You told me offline.
Yeah.
You told us you were the first pension. Well, you worked for the first pension fund to have pitched Bitcoin to institutional investors.
Well, we were the first U.S. pension fund to buy Bitcoin. Mm-hmm. And so we started that process in 2019. And it took about 18 months. What we started doing is we started bringing in educational sessions. We had different speakers come in, like Mark Yusko and Anthony Pompliano and, Dan Moorhead and different folks. And we would just have them give an update, to our pension boards on why adding Bitcoin to a portfolio could make sense. And so, what ended up happening was, 2021, we seeded a fund for Corbin Capital, which was a private credit fund. Mm-hmm. And the folks at Skybridge saw that and they're like, oh, hey, would you guys consider seeding a Bitcoin fund?
Scaramucci's fund.
That's right. Yeah. So Ray Nolte, Scaramucci, and all those folks. And so, so we said, well, I don't think it would pass our board because we've been trying to socialize this for quite a while. But we are the largest US LP in your Series G fund. And if you decide you wanted to allocate 15% to Bitcoin, yet your limited partner agreement allows for that. And we would be very supportive of it. And I will write the memos and kind of, try and provide air cover to explain why we're doing this. And so that's how we originally got into Bitcoin in 2021. It was a 45 basis point position.
Was it very hard to convince everybody to be on board? What was the conversation like?
Yeah, so I think it was definitely hard, and it was a lot of hand wringing when we first got in. A lot of every board meeting. What's going on with the Bitcoin? What's happening here? Because you got to remember these folks are they are fiduciaries. They need to sign off on these things, and they have to be able to explain it to their beneficiaries, right? Which in our case, at the Santa Clara VTA ATU Local 265 pension plan, long name, were bus drivers, train operators. These folks were not people that would normally go out and buy Bitcoin. So we had to kind of explain it to them. Okay, here's why we think this is interesting. We ran quite a few simulations with mean variance optimized portfolios that showed that adding anywhere from 1% to 5% was actually quite attractive to the portfolio. When you got above that, it started to kind of really skew the returns towards whatever Bitcoin was doing. So you had to kind of keep it below that. So our formal first recommendation was for a 1% to 3% position in Bitcoin. And of course, 5 years later, in December of 2024, BlackRock finally came out with their paper saying that they were at 2% as an official recommendation for multi-strat managers.
Mean variance. Are you referring to Markowitz modern portfolio theory?
Yeah, exactly. Yeah. So just trying to optimize the portfolio for the volatility.
Well, this is an interesting topic on its own. Let me just segue into that for just a minute. Okay. Modern portfolio theory uses standard deviation returns over standard deviation. So risk-adjusted returns.
Risk-free, yep.
Bitcoin, however, has a higher Sharpe ratio than all other asset classes. So if you were to use that model, the model should, in theory, just tell you to own Bitcoin.
That's right.
Is it not?
That's right. And if you use the Sortino method, which does not penalize you for upside volatility, because the Sharpe ratio just looks at volatility over the risk-free rate, right? And says, okay, upside, downside vol, we have to look at all of it. On the Sortino ratio, we say we really only care about the downside risk. And so you got a 1.11 currently on the Bitcoin Sharpe ratio versus a Sortino ratio at 2.42. So, in theory, the models will try to over allocate you to Bitcoin because those ratios are so much stronger. So, for context, the S&P 500 is a 72.72 Sharpe ratio versus the 1.11 for Bitcoin. And I think the Sortino ratio is 2.42 for Bitcoin. I think on the S&P, it's like 1.15-ish or so approximately.
Sorry, just one more follow-up and I'll pass it over. So just this is really interesting for me. So I'm a pensioner, right? This is 2019.
Yep.
You're giving me this model that says we should over-allocate to this asset because that's what modern portfolio theory says we should do. And I'm telling you, 2019, you just crashed 80% from the 2017 highs. You're crazy.
Yeah.
Right? Convince me I'm wrong.
Yeah, people basically look at you like you have three heads. They're like, what is this guy talking about? Bitcoin
we just crashed 80%. Now you want me to buy this for my pension.
Yes. And so, it's very interesting because pensions, and our pension in particular, was very much value oriented. So we had value oriented managers, so the idea of buying something on a break, is not necessarily out of the realm, right? It's might be a little counterintuitive to step into a market that's down so much. But if you're a value-oriented investor, it makes a lot of sense, right? You harvest gains from some of your other markets, maybe in your equity markets or your fixed income markets, and then you buy the asset that's on sale. So we did, when we looked at the modeling, we made sure that we did constrain the model because otherwise it would give you just a really ridiculously large allocation of Bitcoin, and then you can't sell that, right? Nobody's going to want to do that. But we said, look, we think between 1 to 3 is pretty manageable. Like we can manage that risk. We can explain that risk. We can make a credible case for why we should be in that zone. And you have to remember back in these days, 2019, 2021, a lot of these pension funds were underfunded. And so we felt like there was just this really asymmetric opportunity with Bitcoin. A couple different ways of looking at how to value it, and we can come to that in a second. But we thought that, the downside versus the upside risk was just very heavily skewed to the upside. And so if we put in 2% of the pension fund, maybe we're risking a 50% draw from there, right? But, that's 1% of the portfolio. We can make that back in 6 weeks on the rest of our portfolio, right? So we would recover that loss. On the flip side, if we were right, and we were talking about, Metcalfe's law in terms of the network effect and, the number of participants on the network, being squared, right? So if there's 2 of us, the network's worth 4. If there's 3 of us, the network's worth 9, et cetera. So you can kind of model it out, and it gives you a very nice pathway of where we think Bitcoin prices could go. And that at that time, back in 2019, 2021, was forecasting like around 150,000-ish, right? Over the next, 5 to 7 years. And so we're like, we think, we can make a pretty strong case for that. It was at 7,000 when we were having the conversation. It went to 17,000 by the time we actually got into Bitcoin. Now, but we still felt like, okay, it's probably on its way to 100, right, at a minimum. And the other way of framing it, if you want to, say, okay, let's look, maybe Metcalfe's law is not the way, but let's go more macro. Like, okay, if we believe that, Bitcoin is kind of very comparable to a digital gold in the sense that it's limited supply, it's impossible to make more of it, it's convertible into any currency anywhere in the world. These characteristics are shared by both gold and Bitcoin. In that case, if we were to say that it goes to parity, that was a 10x, right? So, today Bitcoin sits at a little over 2 trillion, gold sits at a little over 20 trillion. So we get this question, we were on the road, we were visiting pension funds in California 2 weeks ago. We hit 20 different pension funds at the State Association of California Employee Retirement Systems, about $500 billion in that room. And, you get the question, is it too late? Like, am I too late to the party? I'm like, I don't think so. I mean, we got that question in 2019, we got that question in 2021. I actually did a big presentation at Sackers in 2022 where we talked about how we got into Bitcoin. And, that was the impetus of us going back this last couple of weeks ago, was they wanted an update on that because the climate's changed, the sentiment's changing. And, our takeaway was, it's definitely not too late. If you look at Bitcoin, on the capital markets, it's a tiny little orange dot, right? The other $900 trillion out there of assets, Bitcoin's that little tiny $2 trillion orange dot in the top left, right? Mm-hmm. So there's a lot of room. We still believe we're extremely early. Bitcoin's 16 years old. It's just kind of really just getting going, right? So
since we're talking about price prediction, give us your price prediction for the future.
I think in the short term, I would be surprised if Bitcoin was not trading over 200,000, like let's call it the next 6 to 12 months. It might be faster than that because, we look at how much the ETFs are buying. They're buying 500,000 coins, right? We got the corporate Bitcoin treasuries buying another 300,000 coins. We got, new minted coins, 165,000 per year. So we have a huge supply demand imbalance. I'm really surprised that Bitcoin's still trading at like 108, 109.
I'm just curious. We're at a Bitcoin conference. Actually, there was a sign outside that says, no cameras, no whatever, no bears allowed. You know that sign?
Yeah.
Okay. But have you met anybody here that's bearish on Bitcoin besides Peter Schiff?
No, not really. But I haven't been seeking them out either.
Yeah.
There might be a bearish contingent here, but contrarian. But I there's no natural short in Bitcoin.
What would be the bearish case for Bitcoin?
I think the most powerful bearish case would be if like the U.S. taxing authority decide, hey, we're going to tax Bitcoin at 70% or 90%, like what they when U.S. investors had overseas accounts in Switzerland, and they said, hey, you got to bring your money back into America, and if you don't, we're going to tax it at 70%. You have whatever, four months. And if you don't bring it in the 4 months, then we're going to tax it at 90%, right? And they just make it punitive. Something like that would be like what I would say would be a real challenge for Bitcoin, at least from our perspective sitting here in America. Now, everybody outside of America, just buy our Bitcoin.
Do you think BlackRock getting into Bitcoin really helps you or the institutions to adopt Bitcoin?
I think it does. I think, so I would say there's kind of two real critical pivot points. The first one was when President Trump came to Nashville last year at this conference in Nashville. I think that was a major shift, right? In how the future government was going to be looking at Bitcoin. I think the second major shift is when BlackRock launched their ETF, and then this thing was the fastest growing ETF to get to 50 billion, in history, right? And I think that, BlackRock has such a great reputation out there in terms of institutional investors. Almost every pension fund, almost every foundation, every endowment will have a fund that's a BlackRock fund. And so once you've gone through that due diligence process to due diligence a fund with a manager, it's much easier to add a second fund from the manager or a third fund or fourth fund. So I think that having BlackRock on deck with the product really provides a lot of CYA for investors that may have to answer to investment committees, to boards, to oversight organizations. It's kind of like the old saying with IBM, nobody gets fired for buying BlackRock. It's a benchmark standard. So
before we continue with the video, let me tell you about a very important topic. Bitcoin. It's had a 10-year compounding annual growth rate of over 80%, and it's been one of the best performing assets in the world. That means there's a high opportunity cost to spending your Bitcoin savings. Now, with today's sponsor, People's Reserve, and their revolutionary Bitcoin-powered financial products, you can now borrow against your Bitcoin with no credit checks, no income verification, no taxable event, and no rehypothecation risk. Their flagship product, the Bitcoin-powered mortgage, is redefining home ownership for Bitcoiners. And here's the best part. Liquidation risk isn't tied to price volatility, only to non-payment defaults. This protects borrowers and lenders from the biggest risks in traditional crypto lending. With the advent of People's Reserve's revolutionary lending products, you can now unlock the purchasing power of your Bitcoin savings without having to give up ownership. Go to peoplesreserve.com, link down below, or scan the QR code here. Sign up for their newsletter and discover how to build wealth smarter. That's peoplesreserve.com.
After the Bitcoin Strategic Reserve and the BlackRock ETF, everyone's assuming that the institutions are just going to pour in. But, we're not seeing it at that type of level.
I'd agree with that. So we were in Texas last week talking to the Texas pensions. And, they just had their Bitcoin Strategic Reserve approved in the Senate. Yeah. And we expect that Governor Abbott will be signing that in the next week, maybe 2 weeks, that will go into law. It was super interesting. So we, when we were talking up there, I did a poll. I polled the audience. We had 125 people in the audience. I said, how many of you in the audience own Bitcoin yourselves, personally? Have exposure to Bitcoin? Could be an ETF, could be direct. And about half the hands, maybe 40 to 50% went up. And then we said, okay, now of the folks in the room, how many of your institutions own Bitcoin? And it was like 3.
Oh.
So it's not there yet. So you have investment teams that are becoming very familiar with it. They're kind of, starting to get comfortable with Bitcoin, but the institutions haven't shown up in a big way yet.
Because?
Well, I think it's still, they're still on the learning curve, I think that, for 4 years, this was off limits. You just couldn't touch it. You'd have, people, giving you a hard time from Washington. But now it's, the doors have opened. So people are playing catch up. They're trying to get up to speed. We actually get a lot of requests for educational sessions. Can you do kind of what we were doing back in 2019 with our pension board? People are now starting to ask us if we could do that with them and help them with their pension boards.
Well, how would you explain Bitcoin to a pension board today?
Well, I would say, it's electronic money, and I'd say that, it's the real thing that pushed Bitcoin forward is, eliminating the double spend, right? So that's the differentiator between prior solutions and
just from a portfolio allocation standpoint. So, for example, if I were to buy,
I thought you wanted like really basic, like Bitcoin, but I guess your audience, whatever.
Yeah, no, that's good too. But I was wondering more like, okay, so I am a fund and I'm deciding whether to add Bitcoin to my portfolio. Per Bonnie's question, why is it not in my portfolio? So there's a case to be made for everything else right now. Bonds, I get that.
5%,
NASDAQ, NASDAQ, ETFs, small caps, large caps, depending on your firm's bias. Mm-hmm. Even gold is a diversifier. Mm-hmm. What is the role of Bitcoin then?
It's so gold, so much like gold, it's also a diversifier, right? It has a low correlation to a lot of other assets, and it has a very positively skewed right tail on the bell curve distribution of returns. So if you look at Bitcoin versus S&P, S&P has a pretty normal looking bell curve, but if you look at like a Bitcoin bell curve, I don't know if this is coming backwards on the TV, but it's basically a fat right tail. So it's got a lot more large upside months than it has on the large downside months.
Okay.
So you get this great positive skew. So going back to that Sortino ratio, because you have that right side skew of the fat tail, it actually makes it a very attractive asset to add to a portfolio. Now, I guess the second, peeling back the onion further is, is this our expectation going forward? Right? Do we expect that Bitcoin will be able to repeat what it has done in the past? And one thing that we were showing in another presentation with the pensions is, as the market cap of Bitcoin has grown, the volatility has also been declining. Mm-hmm. So if we think about this most recent sell-off, it was about 35% pullback, right? But for a lot of people that have been around for a long time, maybe been through 85% pullbacks or 75% pullbacks, right? But the pullbacks are getting shallower and shallower as the market cap gets bigger and bigger. So, now that would also, on the flip side of the coin, imply that perhaps the upside return will also be a little more muted. That's a tricky one. I think that's more tricky than, looking at downside vol. I think that Bitcoin is an asset that, just because it is, a set supply of 21 million Bitcoins, it's kind of got a little bit of different rules when it comes to the upside because there's not as much float. A lot of people that buy Bitcoin just put it away. They sit on it. They don't do anything with it. They just want to own it. They treat it as a store of value, right? And so, I'm, like I said earlier, I'm really surprised that Bitcoin's not much higher than it is right now, just because of the supply-demand imbalance between the ETFs and the corporate treasuries that are buying so much Bitcoin versus what's being mined.
So why is it, you think?
I don't know. I think that's a good question. I'm sure it has something to do with the market structure. Maybe people that are lightening up at what they think is a pretty significant resistance level at 109. That is, if you look at long-term monthly charts, that is a big trend line that comes in above the market and seems to have been like a place where some folks are selling. That whole 105, 109 window seems to be a popular sell area.
Is the main goal for pension fund, the main goal should be to make money, right?
Yeah. So the main goal for a pension fund is to be able to kind of meet their liabilities, right? Because when you establish a pension fund, you're contributing capital in, and the idea is that you're going to be working for 30 years, and the investments are going to increase in value, and actually about 70% of the future payout that you will be receiving is generally generated from market performance. Mm-hmm. So, if, let's say, for example, I'm just going to make up a number here to make this simple math, but let's say, you were going to collect, $100,000 in your pension. You would have probably contributed about $30,000, and that other $70,000 that's paying out your benefit is through market appreciation, generally speaking. So, it's important to have assets that are appreciating.
So Bitcoin is the best performing asset. Why only 2-3%?
Well, okay, so that's a good question too. So, and this is something that we're trying to back into with the pension funds is like, okay, what is the right amount that you can? So, if you think about like the contribution of a FANG stock to a normal portfolio, like a 60-40 pension portfolio, it is approximately 4% on average is the volatility contribution to the portfolio from the FANG stock. We have 7 FANG stocks. We got, Magnificent 7, I should be saying. The Magnificent 7. So you have 7 of them. That's approximately 28% of the portfolio vol comes from those 7 stocks. Now, if we were to try to defend a position in Bitcoin, if you had a 2% position in Bitcoin, you have approximately about a 5% contribution to the overall portfolio volatility. So, you can kind of make a case, well, if you're okay with, Facebook or, one of the Magnificent 7 stocks, Apple, whatever, you should be okay with the volatility that's being introduced by Bitcoin if it's sized similarly. Now, that means in that case, it has to be about a 2% position.
I want to talk about your new fund. You have 3 products: yield, income, and alpha.
Yes.
Can you break it down for us?
Yeah. So, Blockstream is, historically been a company that is this technology service provider to the Bitcoin ecosystem, right? So Blockstream has historically also been kind of built by solving their own problems, right? They are old Bitcoiners that are been around forever, and they come into problems and like, well, how do we solve this? Well, we'll just build it.
You sound like Adam Beck.
Yeah, well, I've been spending a lot of time with Adam. Maybe I've heard his.
You become the 5 closest people around you.
Yeah, right. Yeah. Well, I've been on the road with Adam for a month. So, and this is one of the really fun things about this role, like leaving a, hedge fund to join Blockstream. It's like, why would you do that? Like, you're a GP at a hedge fund. You're making great income. Why would you leave that on the table? You just won Multi-Strat Credit Hedge Fund of the Year, 2022, 2023, back to back. You beat PIMCO, Bloomberg Hedge Week. But every time I'd talk to the Blockstreamers, and every time I'd hang up the phone, I'd say to my wife, I'm like, man, that was an interesting conversation. Like, these folks are working on some really interesting challenges and problems that, when you're a credit hedge fund manager, or, you kind of have a playbook, you stay in your playbook, you stay in your swim lane. If you do everything right, you'll be one of the top performing funds, and maybe you'll have a Bloomberg Hedge Week award, and so this is where, we're really going into uncharted territory where, for example, with our Bitcoin yield fund, I would describe it as, hey, we've got a machete, we're in the jungle, and we are hacking our path through. We are trying to figure out how can we do this safely and without risking our Bitcoin. Because believe me, nobody at Blockstream wants to lose their Bitcoin, right? And we are our own biggest customer. We are our own dog food. So that's what we're working on. So on the Bitcoin yield fund, there's a couple of different ways you can look at this. And again, I should caveat it because people will be like, well, what kind of return? Well, it's a very low return. So on the yield fund, we're looking at a 2 to 4% return. So very, very almost like a money market we're trying to create. So how do you do that? How do you get yield on Bitcoin? Well, there's certainly options strategies that people are using to try to do this. It can be a little more risky in terms of the call side of things, getting your Bitcoin called away. But
there's selling call options on Bitcoin. Is that it?
Yeah, that's a very common strategy. We're exploring that, but you have to be very careful about selling upside in Bitcoin. Now if you tell me, hey, Sean, we're interested in selling puts. Oh, okay. I'm always happy to own Bitcoin on a break. Right? I'll take that trade all day. So that one is a little more easy to do. But then you also have other opportunities with like ETPs, right? So we have this huge surge of growth that, with the exchange traded funds. And, the exchange traded funds, may have a big flow into the fund, and they may not be able to buy all the Bitcoin in the open market that they need to buy that day. So they borrow Bitcoin on an overnight revolver, right? And so those are interesting ways of capturing yield.
Yes.
Bitcoin miners, right? Those folks, some of those folks will borrow Bitcoin to pay expenses, but understanding and knowing that they are going to be mining and minting new Bitcoins.
Why do you think Bitcoin miners have underperformed Bitcoin this year?
I think it's a very, very, very capital intensive business, and, I've actually financed a couple of Bitcoin miners at my prior hedge fund, Prime Meridian Capital Management. We financed some Bitcoin miners up in Ohio that were connected into a nuclear power plant, and we did it a little differently. We were like, okay, for collateral, we don't want the ASICs. We want your commercial grade electrical equipment, the transformers, the substation, the mid voltage electric, et cetera. We need a perfected lien on those assets, because if you are going sideways, those are the assets that we could sell in the secondary market to actually get our money back. Those Bitcoin ASICs, depreciate like a lead balloon. So we did that approach, and then we took some equity warrants on the holdco. But what I came away from during that whole underwriting experience is it's a very capital intensive business. It's a very competitive business. Your cost of energy is critical. That's why West Texas and these places are so popular. It's really a shame that places like Quebec that have all this hydro aren't capturing that. Like, they could be building their sovereign Bitcoin Treasury with basically free electricity. Like Bhutan is doing that, right? With BitDeer and those folks, they're doing that. They're actually making that happen. So I think miners underperforming. I think it's if you peel back the onion, it's the capital intensity is just much higher, cost of capital.
You speak Wall Street language. When you meet Bitcoiners, they're in hoodies.
Yeah,
they are in front of their computers all day.
Yes.
Was there
I'm only wearing the suit because I had to give a speech on the stage.
Oh,
I don't normally wear this.
So you're usually in hoodies.
Not a hoodie, but business casual.
Okay.
Yeah, I'm not quite the hoodie, but yeah, no, it's true. Yeah.
Was it there like a culture shock?
Well, I grew up in the Silicon Valley. So, I went to high school in the Silicon Valley. I went to the Stanford Business School, so I've always been around the Silicon Valley. My dad was in the technology industry. So I remember when Apple was going public and, getting, going back to 1976, getting a Commodore PET computer, right? This is very unusual at that time. My dad bringing home a suitcase that was the first portable laptop called an Osborne, with a little tiny screen like this big that was green letters, and this crazy, huge, clunky keyboard. So I've always been around the techies, and the Silicon Valley's changed a lot. When we were there in the 80s, my dad was a submariner, conservative guy with General Electric, and, technology oriented. But he had a lot of buddies that were like leftover hippies from the 60s, right? My dad was very straight laced. So when he put his Birkenstocks on, he'd have his black business socks or white, socks, and be like, what's this guy doing? But the other dudes, would be further left of my dad in the politics and what have you. But everybody was very interested in the technology and very interested in tinkering, and everybody was pretty mellow on politics back in those days. Certainly, having watched the Silicon Valley evolve over the years, certainly we saw the hoodie culture come in with Mark Zuckerberg and those folks, and it's still there.
Going back to the three funds, we haven't talked about the Alpha Fund.
Yeah. So the Alpha Funds, so we have the yield fund that we just talked about. We have an income fund, and then we have an Alpha Fund. So the yield fund is really kind of targeted towards like a hodler or a Bitcoin Treasury company, that type of folks. Okay, you're getting 0 on your Bitcoin, but now we can get you 2. Okay, so they're probably pretty deep in the Bitcoin world, right? These folks that want to look at our fund. On the other side of the extreme, the Alpha Fund is for people that, maybe have got passive Bitcoin exposure. So maybe it's a pension fund that has an ETF exposure with IBIT, or, one of the other ETFs. And now they've got their passive slug of Bitcoin allocation. They're looking for some active management around it to complement that. So to kind of buttress that core Bitcoin allocations, right? And so there, we're really focused on, the model. Our business model is like very much like a Millennium or a Point72 or a Citadel, where we have siloed trading teams. And so some of those trading teams will be focused on high frequency trading. Some of those trading teams will be focused on options market making, right? And options are a really good example of like how inefficient the Bitcoin ecosystem is, because if you think about an option, as the maturity goes out, as the strike price goes up, you should have a very smooth smile to the curve. But if you look at like a Bitcoin option curve, it's like, it's all like, oh, geez, this thing's all kinked and out of whack, right? So there's a lot of opportunity to actually just arb options prices. We've all heard about the basis trading, right, with the perps and the spot. Those trades come and go, but they can be quite attractive, right, when they're there. Inter-exchange arbitrage, surprisingly, every once in a while, we'll see a gap between Bitfinex and Coinbase. It could be $375. We're like, wow, why is this not getting taken out? Why isn't somebody arbing this out? So there's just, all these different interesting strategies. We do relative value between the Bitcoin Treasury companies, and even between Bitcoin and the Treasury company stock, right? We have, all kinds of different strategies that we're working on in the Alpha Fund. So I would say our yield fund for the old school, Bitcoin hodlers and corporate treasuries, our Alpha Fund for the folks that are further along the journey than most, but maybe, need to add some kind of active management to their portfolio. And then our income fund, which is really the reason why we started the hedge funds, was the income fund, because we could run, our yield and alpha funds just out of our treasury. We could just plug in Bitcoin. But when we thought about one of the biggest bottlenecks in the ecosystem, it was how do you unlock all this wealth creation that has happened in the Bitcoin ecosystem? Like, you have these folks that are sitting on tremendous amounts of Bitcoin that don't want to sell it and don't want to trigger taxes, and they would actually like to borrow against their Bitcoin, right? But you can't put your Bitcoin on deposit with Merrill Lynch. You can't go bring it over to UBS or Goldman Sachs or wherever you bank. And normally we would say, oh, hey, I got my portfolio and I'm going to cross margin and take a loan against my portfolio, like Elon or some of the other folks do, and you never have to sell anything. But that's not really easy to do if you're in the Bitcoin world. So we were trying to think, like, how do we catalyze this, and how do we act as a catalyst to kind of speed up the flywheel, turn the flywheel faster? And we're like, well, who's naturally long dollars? Like, who's sitting on dollars? Well, okay, that would be your sovereign wealth out of the Middle East, and your pension funds here in the U.S., your foundations, your endowments. Those folks are all generally long dollars. And what kind of investment vehicle would we need to create to get them to come into this Bitcoin ecosystem? Well, in general, they're most used to like a hedge fund structure. And that hedge fund should be in the Cayman Islands, right? And that's the structure that their lawyers are familiar with. That's the structure that they like. And so that's what we decided, okay, well, let's create a fund out of the Cayman Islands for the income strategy. At a high level, we're looking at 0 for overnight to 12-month loans. We're looking at LTVs between 25 to 65%. And then we just have a matrix pricing. So if you say, hey, I want a 3-month loan at a 25% LTV, so 4 times over collateralized, you're going to be at the very low end of our interest rate, matrix. You'd be like 7.5%, 8%. If you say, oh, hey, Sean, you know what? We want to go 65% LTV for 12 months. Then we're going to be at the higher end. We think it'll be right around 12. So we kind of were trying to play in that window. We kind of view the credit markets and Bitcoin as being very underdeveloped, right? There's 2 trillion plus in value in the Bitcoin ecosystem. But there's only like $16 billion of hedge fund money trading around in this ecosystem. And a lot of that's focused on altcoins. It's not even focused on Bitcoin. We think that in the Bitcoin ecosystem, it might be as low as maybe 5 billion, right? And that's why you have some of these inefficiencies that are occurring in these markets. So we think that if we can kind of unlock these credit markets, on both, borrowing, against your Bitcoin or lending your Bitcoin, it's a good service to provide to the Bitcoin ecosystem. And then if we can kind of, try to tackle the capital market space with our alpha fund, again, trying to bring more efficiency to that market. And, in a perfect world, down the road, at some point, we put ourselves out of business, right? These markets are too efficient. There's no extra alpha, nothing there for us to capture anymore. But right now, that's definitely not the case.
I know it's Blockstream. I know it's a bunch of Bitcoiners. But if it was you personally starting a new fund, would you have added altcoins?
We are open to sucking money out of Ethereum, through high frequency trading and then converting it into Bitcoin. So, we are open to sucking money out of Solana and then converting it into more Bitcoin.
That is so scary when he says it. I will suck the money out of Solana.
Well, the altcoin vampire fund. That's what we're going to call you.
Yeah. Well, we do believe that Bitcoin is the first mover, has the big advantage. It's a black hole, and all these things are going to get sucked into it over time. In our mind, it's all about how do we get more Bitcoin? We want more Bitcoin. And so, if we're going into some of these altcoins, dealing with the ETH heads and all the problems they bring into the ecosystem, then we got to take a toll. We got to take some money out of there and convert it back into Bitcoin. So
for your alpha fund, I'm just wondering, because you're using Bitcoin to essentially outperform Bitcoin, timing the markets is probably very crucial for you. So what are some important timing indicators that your fund or your traders look at?
Well, we really try not to be kind of market timers. We try to be timing the market, if that makes sense.
We also explain that.
Yeah, jinxed.
Yeah. So if in Bitcoin, and this is not uncommon for other asset classes too, like in S&P 500 and different things. I think in the S&P 500 is 24 days, and Bitcoin, I think it might be as little as 12 days. Like if you miss the biggest 12 days in Bitcoin, you miss the return for the year, right? So if you're trying to market time, a market that's got a compound annual growth rate of over 65%, you got to be very careful not to miss that upside, right? Because you have a very strong tailwind here. So we think the opportunities are more in the relative value type of plays, like we were talking about options market making and relative value between Bitcoin Treasury companies and high frequency trading where we're in and out of the market, but we're not really taking long short risk in terms of sitting on cash. Now are there going to be times where we want to step on the gas a little, and maybe put a little extra long exposure on? We're pretty bullish on Bitcoin, so yes, that's kind of like the way we look at Bitcoin. But technical indicators, I really like Tom DeMark's technical research. He's one of my favorite technicians. We follow him pretty closely. There's some other ones that we like to like. Larry Williams. He's also got some really interesting research. And then having started out at the Chicago Board of Trade in 1994. I actually took a lot of those classes with the people that wrote the books. So Sheldon Natenberg on option pricing and volatility theory, Lawrence McMillan on the options manual, John Murphy, on technical analysis, and Steve Nissan on candlesticks. And I've taken the classes with all the guys that wrote those books, and so I'm definitely very in tune, I think, with technicals of the markets, and we try to take advantage of that.
Earlier, you were talking about Bitcoin treasury companies. We had Simon from Metaplanet yesterday, and there was a news that says their stock price is 6 times premium.
MNAV.
What is a fair value?
Well, it depends how fast they're growing their Bitcoin stash, right? So Metaplanet has been growing their Bitcoin stash pretty aggressively, right? Now, if you have, a good way to think of that would be, okay, Metaplanet's one of the newer players on the block, started with a relatively small stash. They've been doing some big, issuance and buying Bitcoin with that. Go to the other extreme, the Bitcoin pioneer, Michael Saylor and Strategy is a much more mature company, a much bigger company, right? And, they are still accumulating tremendous amounts of Bitcoin, but as a percentage of their overall Bitcoin, it's a little slower. So it would have a lower MNAV. So that one, I think might be 1.5, 2, whereas Metaplanet's at 6. So it really kind of depends on where they are in their cycle and the speed and the consistency of the program to accumulate more Bitcoin.
So it's not fair to compare Strategy.
Yeah, I think they're
Metaplanet.
just at different points in their life cycle. You know, I mean, I think like, you know, strategy is, you know, I mean, they are the first mover. They got the first mover advantage, and they're kind of building out the whole capital stack, right? With their, you know, strategy, their Strife, their Strike, their Misty, you know, their convertible notes, their secured lending notes. I mean, like, you know, where do you want to be on the risk curve? And, you know, MicroStrategy's probably got a product for you. You know,
let me play for you this clip.
Yeah.
Of Michael Saylor responding to a question about MNAV going negative.
Yeah.
Respond to that. It's 30 seconds.
Yeah.
We constructed the company so that the company can generate yield and generate gains even at NAV or below NAV. For example, we have $64 billion of Bitcoin. If the stock were to trade to $1 tomorrow, well, we wouldn't sell the equity, duh. We would just sell the preferred stock. We would be selling stock over collateralized 10-to-1 against Bitcoin with a 10% yield, and we would generate billions of dollars of gains selling the preferred or the fixed income instrument. At some point, people would say, wow, they're generating gains anyway, and then the value would come back into the equity.
Yeah. So, I mean, like, so I think what Saylor is saying there is like, okay, if the common stock price crashes, let's say it went to 1 or something like what he used there, there are other instruments that we can provide that would still be attractive to investors, that we would still be able to issue stock, in this case, the preferreds, and then we could still go out and buy Bitcoin and continue to grow our Bitcoin stash. So I think that's what he's going after there. I think, you know, there's a super interesting technical dislocation in the market with, you know, convertible debt that you can issue at 0% interest rate with a conversion premium that's 35 to 50%. You know, if you say, hey, Sean, you know, I'll give you $1 billion at 0% interest, you know, well, yeah, I will go buy Bitcoin with that because I'm pretty certain I'm going to outperform 0, right? If I have at least a 5-year window to ride through. So I think, you know, Saylor has, built the full capital stack really. And to his point there, I think he's just saying that, you know, it's not just issuing equity. It could be preferreds. It could be, you know, converts, whatever the market wants. He's willing to work with them on that. The other interesting thing is on the preferreds that he's talking about there. Let's say the market does dump and let's say Bitcoin goes down substantially, right? Instead of the stock, right? Well, he can just postpone, and delay paying out that dividend on those preferreds, right? They will still accumulate. He'll owe that down the road, but like he won't get into a cash crunch per se, right? He won't. He can basically put those on hold. So
there is this thing called Liquid Network, and it has something to do with your T+2 settlement. Well,
Liquid is, again, block streamers solving their own problems. So, you know, the Bitcoin blockchain, you know, block every 10 minutes, you know, full transparency, right? So we know exactly what Sean bought, you know, when he bought it, how much he spent on it, if we know his wallet, right? So the block streamers are like, gee whiz, like, you know, could we make a faster settlement? Could we go to a 1-minute block and for settlement? And could we provide confidential transaction capability so that we don't know what Sean bought or sold. We just know that, you know, money moved from this wallet to that wallet. And that was kind of the idea with the Liquid Layer 2 network, which is, I think right now, the second largest L2 on the Bitcoin protocol after Babylon. I think we have approximately $3.2 billion on that chain. We don't really advertise it a lot or talk about it a lot, but it's, you know, all Bitcoin native, you know, financial products or, you know, financial products that were traditional that needed kind of a technical update. So like a good example is we have $1.8 billion of notes from Mexico for small businesses. And, you know, Mexico is pretty inefficient. Paper is how things were getting done. And they kind of switched over to DocuSign and got things tokenized and put them on Liquid, and boom, this market just took off. And so we have U.S. banks that are buying, you know, Mexican small business loans that are rolled up and packaged on Liquid, and just really, you know, fueling the democratization of access to capital for the Mexican, you know, retail and small business crowd. So I think I think liquid layer 2, I think is going to be something really to keep a close eye on. I think when I joined, we had, which was 7 months ago, we had about 1.6 billion on that chain. And it's, basically now doubled in 6 months. So I think we'll be probably I would not be surprised if we overtook Babylon in the not too distant future.
Go ahead.
Adam Back talked about when Bitcoin first came out, people were not very comfortable with the transparency. Mm-hmm. There was no privacy.
Yes.
But now people are building all these layer 2s to protect their privacy.
Mm-hmm.
How should we look at it? Which is better?
Well, I think, there's certainly a lot of benefits to the Bitcoin, the way it was designed to provide sunshine on transactions, right? Everybody, I think, in the Bitcoin ecosystem knows you do not want to be doing nefarious business on the Bitcoin blockchain. That's a really bad idea. On the flip side, do I necessarily want people knowing exactly what's in my bank account? Do I want people to necessarily have that visibility? So if we think about our regular banking accounts right now, you may know my checking account number to maybe you sent money or pulled money from it, but you wouldn't know the balance, right? And so I think some of these layer 2s are basically kind of providing some of that functionality where, okay, maybe you have the wallet address, but you wouldn't necessarily have visibility into the amount of money in the wallet, which is, good for privacy, I think. So I guess that's one of the things I think the cypherpunks, which Adam's one of the OGs of the cypherpunk crowd. I think those folks really do value privacy, right? They're all cryptographers and want to protect their privacy, the freedom of speech and these things. And, I think that's kind of why you see some of those layer 2s, why they were working on them.
Well, I have one more question for you. Give us one trading mistake you've made on Bitcoin, lessons we can all learn from that.
Oh, yeah. Okay. So this is actually a very interesting question. Mm-hmm. And for context, I was having a conversation with a fellow who's done quite well in Bitcoin, one of these whales. And I said, geez, man, I'm like, how were you able to sit on your Bitcoin? Okay. You're a middle-class guy. All of a sudden you're worth $100 million. Weren't you tempted to ring that register? What about when you hit $1 billion? Weren't you tempted to ring that register? Okay, so you made it past $1 billion. Now, when you hit 10 billion, weren't you kind of tempted to hit that register? And, the story that I was told was that these folks that were very early had made this decision to sell some of their Bitcoins to buy whatever it was. Could have been a car, could have been a nice trip for the family. But, they got in when Bitcoin was, 10 cents or $1 or whatever. And so, hey, when it hit $1, I'm going to sell some Bitcoin and buy whatever I was going to buy. And then, oh, hey, Bitcoin hit $10. I'm going to sell some Bitcoin and buy some more stuff. Wow. Okay. Now it's at $100. I sold some stuff, but geez, every time I sell it, it keeps going up, right? So this is becoming very expensive purchases. And so those folks were just very early to get that lesson learned. So for me, I first heard about Bitcoin in 2014. I first started buying Bitcoin in 2016. And so I came into the picture later, right? So I was I had to run up to 1,000, 1,100, whatever it was, and then crashed down to 250. I had some technical alerts on the markets. By the time I got my Coinbase account open, by the time I got Bank of America to transfer the money and Coinbase to accept it and let me actually buy the Bitcoin, it was at $456. And when Bitcoin ran up to 12,600 or whatever it was, I'm like, I just made 38 times my money. As a macro investor,
that's insane.
This is insane. I have to ring the register. Mm. Then I watched it go to 20. I'm like, oh my God, this thing just went to 20,000. I'm like, shit, I got to figure out how to get back in. Mm. Right. And then it crashed down to 3,700, which was my technical level. I'm like, okay, I got my orders in, I'm buying, getting back in. And, I'm like, okay, I'm just going to sit tight. And then boom, we're on our way back up to 20. I'm like, okay, this is probably a double top, right? Being a technician, it's probably going to be a double top, sell it at 20, made another 6 times my money, feeling good. And then boom, it pops through, it goes to 60,000. So I'm like, jeez. I'm like, I just sat on my original Bitcoin at 450 and just let it, and this is going back to our earlier conversation about time in the market versus timing the market. And this was a very painful lesson to learn, but better to learn it, earlier than later, right? And, so then when it came back down to 17,000, I reload again. And that was the last time I sold,
We were talking to Michael Turpin yesterday, and he has a book that talks about the 4 seasons in Bitcoin. And basically, it's been proven many times that the seasons are correct. And his argument is if you could just sell in summer and buy in winter, you could have 4x your Bitcoin amount.
I'll have to go read Mr. Turpin's book.
But do you think regular investor could do that?
Well, you do see some of those types of patterns in traditional markets. So it's certainly possible. I'd have to go look at it and read it. There are people that trade this presidential cycles, and they sell in May and go away, and that's also like kind of maybe another version of this, right? Close to the summer. It wouldn't surprise me if there was some cycle like that. Very hard though for, I think, retail folks to stay disciplined on that. Because if you're out traveling and you forget about it and you don't get it back on, then you're like, oh God, now I gotta pay up, right, to get it back into this position. So I think, again, for most folks, dollar cost averaging in, time in the market, let it compound. And we think there's a very strong case for, and I'm not giving investment advice, but we think there's a very strong case that Bitcoin can 10x from here. $1 million Bitcoin would not be surprising to us.
All right, let's end it on that happy, hopeful note. Thank you very much, Sean.
Okay, thanks for having me.
My pleasure.
Yep. Thanks for having me. Yep. Thanks for having me. Yep.